name is Mattia Romani. I'm the Deputy Director General and Chief Economist of the Global Green Growth Institute. And thanks for coming to the session, which is dedicated to the new financial architecture for sustainable infrastructure. So why a session on this in this forum? Well, I think the idea of this session came from the increasing realization of the shortcomings that the current financial architecture is showing in terms of meeting the demand for financing for sustainable infrastructure in developing and emerging countries. And this has not only come out of some of the analytical work that the GGGI with others have done on looking at this gap, but also from looking around the world and seeing a number of initiatives, small and large, which are coming up in different countries around the world, which seem to indicate the need for new institutions to fill in this space. And I'm thinking about, of course, the GCF, the New Development Bank, the BRICS are thinking about, but many other initiatives that we're seeing at the bilateral level, many in Asia. Also, we are seeing a number of new initiatives, particularly from developing and emerging countries, trying to find the best possible solution to finance infrastructure in Africa. China's been very active in the continent. Brazil is increasingly active in the continent. So I think the analytical work plus the simple observation that this new institutions are coming up poses really the question of what is the space going to look like in 10 years' time. And somebody else said in this very room, I think, that the best way to predict the future is help build it. So somehow this session has the very modest aspiration of trying to build a little bit of that future and explore what are some of the characteristics that we would want this architecture, this almost biosystem, it's not really a fixed architecture, to have. And we've lined up a fantastic set of panelists for this that I'll quickly introduce. We have Amar Bhattacharya, who's the director of the Group of 24, which represents developing and emerging countries at the international financial institutions. Mostly has been thinking for a long time about this and has decades of experience. And next to him, we have Ewan MacDonald, who is Deputy Director General with USAID and is also the co-chair on the Green Climate Fund, that can tell us about that. And next to him, we have Mkoshi Fetla-Lekete, who is at the Treasury in South Africa. She's the Deputy Director General for International Policy, has been intimately involved in the thinking of the new development bank. Brinduza Fidanza, who brings private sector experience. She's with WEF. She is an associate director there looking at climate and has been involved with creating the G2A2 Green Growth Action Alliance network of private and public institutions, and then Emanuele Fanelli with a Carbon Disclosure Project, which comes from a very different angle, the angle of institutional investors and what can be done to involve them more directly in the financing of sustainable infrastructure. So let me then pass the microphone on to Amar, who's going to kick us off with his lead presentation. Thanks, Amar.
Good afternoon, everybody. I'm Amar Bhattacharya, as Mattia mentioned. I'm going to present some work which Mattia and I have been doing for some time. It's based on a joint paper with Lord Stern, and particularly on the thinking regarding new institutions. It's benefited a lot from his input as well as that from Professor Joe Stiglitz. Having said that, I'm not really shy about saying what I'll say is on my own behalf, and so I'll be quite free to share with you my own perspectives and and hopefully give you a basis for discussion. I intend to speak on three things. I want to talk about the critical importance of infrastructure right now to green growth. There are many other dimensions other than infrastructure to green growth, but I'm going to focus on infrastructure because I do believe it's actually the largest segment. Second, I'm going to give you an overview of the global development financing architecture, and I'm going to focus on one part of the potential solution, which is the role of a new development bank, and of course by that we really mean the initiative that has been launched by BRICS leaders. But there are other clearly other solutions as well. The Green Climate Fund is a very, very important one. And some of what I will say is relevant for the Green Climate Fund. But the other aspect that the Green Climate Fund brings to the discussion is concessionality, or potential concessionality and leverage, which is very important. But also a lot of what I have to say is relevant to a lot of the new thinking going on about other institutions in the World Bank, in the African Development Bank, in the Asian Development Bank. So, this should be seen as an input to how can we change the architecture. I have to warn you that I have quite a few slides, but the reason for that is to make it available to you. So if I rush through it, don't worry, you will have the presentation, you can look at it in your own time. So the starting point is, as I said, is green growth and infrastructure are intricately and inextricably linked. If we get, there's huge demands for infrastructure. If we get infrastructure right, we get green growth right. If we get it wrong, we will systematically destroy the planet. So that's how important it is. So what are the gaps? Well, what's the importance and what are the gaps? So infrastructure at this is absolutely critical right now for meeting the growth aspirations of the developing world. The developing world, as I mentioned yesterday, have been doing very well in terms of growth, but increasingly their growth is being stymied by the lack of infrastructure. And this is not just a kind of a physical infrastructure, it's the importance of network externalities, the nature of the structural change, etc., taking place. And one very important dimension of structural change is urbanization. In the next 2.5 decades, the world will add 2 billion people to the planet. All of that increase will be in urban settlements. So providing for that will be a huge demand for infrastructure. It's also critical for inclusion, as we heard. The challenge still is that a vast number of people actually, it's not a question of green infrastructure, it's a question of any infrastructure. And finally, sustainability and resilience, meaning that ensuring that the footprint of this infrastructure is sustainable is going to be a key challenge. So this is my speeding through now. So large infrastructure deficits that exist in many developing countries, slowing growth and development. This is our summary slide of what we see as the needs of infrastructure. Currently, we are spending about 800 billion, our best estimates, per year on infrastructure. And the work that we've been doing with GGGI suggests that amount of spending needs to rise to about 1.8 to around, say, let's say 2 trillion. And this tells you that the bulk of the increase is going to be in East Asia, but in relative terms, Sub-Saharan Africa and South Asia much more important. In terms of sectors, energy and in particular electricity, dominant, followed by water. And in terms of the type of spending, construction obviously is the big spending. But one of the important things about infrastructure is the amount of money needed for preparation, including project preparation, is relatively large, and that acts as quite of an impediment in the financing of large infrastructure. Now, we've done these numbers. I just want to say that there are uncertainties surrounding these numbers, and it's important to examine the sources of these uncertainties. First is the scope of efficiency gains. A lot of work that has been done by McKinsey Global Institute suggests that you could save as much as 40%, not just in developing, but in developed country infrastructure if you got it right. That's huge because these are very capital intensive spending. But I should say that getting it right will be more difficult in the developing world than it will be in the developed world. So we shouldn't kind of have exaggerated expectations about efficiency gains. Second, we find kind of differences between what we would call top-down or econometric estimates that we have undertaken versus the more bottom-up country plans. And if you just take the BRICS countries, you see, for example, it gives you a good idea of country plans, but in general, we find that the country plans tend to be more constrained, less ambitious than what you would estimate in terms of macro needs. Very important issue that we were discussing just before the session is the critical importance of project preparation. In infrastructure, is typically a planning of a public good with not only externalities, but with network externalities. That requires decision making, which is inherently complicated. You cannot do a roads project without thinking about connectivity, and you have to be able to order them right. And even when you have chosen a road project, then undertaking the preparation of that project can be a very difficult endeavor. And currently, a major problem is the lack of an adequate infrastructure pipeline, or what we would call bankable projects. And this is inhibited by lack of institutional capacity, technical capacity, and financing. And this is something I will come to when I talk about the architecture. Linking infrastructure to green growth, critical, of course, is climate mitigation, climate adaptation. In the Stern report for mitigation, for example, the assessment was the world needs to spend about between 1% to 2% of GDP on the mitigation side. But there's a lot of uncertainty particularly because we don't know yet very much about the payoffs on some of this. In contrast, on adaptation, it's really an expenditure which you don't have that kind of co-benefits. It's really an expenditure of prevention or of absorption of loss. And the kinds of numbers we are talking about is about 100 to 200 billion annually for adaptation, and about 200 to 300 billion for additional to what I had mentioned. And finally, it's very important in developing countries to stress that operations and maintenance of assets is key. The reality is that most developing countries do not do a good job of operations and maintenance. And unfortunately, as the capital stock goes, the pressures to maintain them and operate them well and allocate adequate funding will be a big challenge. In addition, the nature of financing for infrastructure is very different than normal projects. You have very, very large upfront costs, and the payoff is long-term, low, and subject to all kinds of uncertainties. And that has, of course, very important implications for financing. Now, quick overview on the global development financing architecture for infrastructure. And as I mentioned, the current financing is let's say, in the order of 800 to 900 billion. So where does the money for this come from? The bulk of the money comes from public budgets. Okay, today, about between 500 to, let's say, 600. National development banks play a very big role, in particular in some of the bigger countries, Mexico, Brazil, China, very big role. Other developing country finance of the kind that Mathieu mentioned, beginning to play a role, but as you can see, still rather modest. Official development assistance and MDBs are in aggregate very, very modest compared to the totality of overall spending. That's not necessarily a problem, but it is a problem when you think about the ambition of future spending. And private finance has been quite tumultuous and is, in a sense, less than one would have expected when we were thinking about the potential of private finance for infrastructure. And there are many reasons for it, and we'll come to it. Now, public finance is important, but will be constrained going forward in two ways. I don't have a graph here, but I put it here. But if you look at public finance post the financial crisis, you will find that the fiscal space is more constrained, not just in the developed world, but in the developing world as well. The second constraint of public finance, and it's a very important constraint when it comes to thinking about infrastructure, it does not make sense to pay for infrastructure that benefits a richer future generation on the backs of a poorer generation right now. The infrastructure, can absorb quite a large amount of money, and you have to remember that the tax base and the per capita income of today's citizenry is relatively modest. So you can't, there are strict limits on what you can do from just public finance. Yes, it should finance operations and maintenance. Yes, there should be better cost recovery and all that. But to finance, in a country like Ethiopia, long-term investment on the back of just today's public budget, not really a viable proposition. As I said, ODA plays an important role in poor countries, but it's a small proportion. And there are two reasons why it's a small proportion. One is that actually DAC countries, or many DAC countries, by their choosing, have chosen not to finance a lot of infrastructure. They've done health, education, general budget support, infrastructure relatively small. Let me give you a very powerful number. If you look at the aggregate DAC ODA, you will find that the amount that is spent on infrastructure is 20% at most. If you look at the spending by the BRICS countries in terms of the assistance that they give, the share of infrastructure is 80%. And the same is true of the Middle East funds. So, by the way, Japan and Korea have not actually had that tradition. So this kind of difference in composition has been an important issue. MDB financing, which used to be huge, if you look at the history of the World Bank and the role that it played in the financing of infrastructure in Japan, in Europe after World War II, you will see that the bulk of the financing they were doing was infrastructure. But if you look today, that share is much lower, and indeed the share has actually gone up. There was a period in the 90s when the World Bank, for example, basically extricated itself out of infrastructure because of the complexities of the issues and the controversies of the issues. They have increased greatly their financing after the 2009 crisis, but it is not greenfield projects primarily. The Asian Development Bank, the Inter-American Development Bank still do greenfield projects. The World Bank's financing, a lot of it is in the form of sector loans, policy-based loans, which are good, but they don't help in intermediating the kind of collective action issues that you face with regard to greenfield projects. For example, if you look at the World Bank portfolio today, there are no major hydropower projects left. Who's financing hydropower projects in Africa? It's China. So it's an interesting contrast where the World Bank is today from where it used to be. So a lot of infrastructure can only be financed if the private sector is engaged, given the magnitude of the needs, and also because private sector activity brings a very important efficiency gains to the table. The flip side is there are also many activities that the private sector cannot finance, but let's look at the potential for the private sector. And as I said, private sector constitutes right now about 20 to 30% of infrastructure financing. What's striking is that after the crisis, infrastructure lending has fallen sharply. Why is that? Well, one was the deleveraging of the European banks, but the other is the kicking in of the regulatory capital requirements from Basel III. And this is something that has to be looked at, and it is indeed on the table. The G20 is very much focusing on it. I know for my colleagues in the BIS and the FSB are also focusing on it, but it is issues important. Before I leave private finance, I should say that there are pools of private finance that are largely untapped, especially pension funds. At the moment, only 1% of pension fund assets are in infrastructure. The OECD is doing a lot of work right now examining the potential for tapping this. But when you look at the 75 trillion under management, clearly there's a big potential in terms of financing. The nature of risks in infrastructure, as I mentioned, is a key constraint, and I won't spend time on it. Let me just say that when you add it all up, one of the interesting stories is the difference in the international financing architecture across countries and across regions. And let me take the case of Latin America. In the case of Latin America, the World Bank does infrastructure, but it is actually, in a sense, the junior player. The Inter-American Development Bank finances twice as much infrastructure as the World Bank does in Latin America. The regional, sub-regional bank, which we call CAF, or the Latin American Development Bank now as it's called, does as much infrastructure as the World Bank and the Inter-American Development Bank combined, and the Brazilian Development Bank does more than all these three institutions. So we have a reverse pyramid. But that's the only region. When you look in contrast at Sub-Saharan Africa, there isn't that kind of scale. The African Development Bank is thinking about stepping up, but at the moment, really, the gaps are definitely the largest in Sub-Saharan Africa, and also, I would argue, in South Asia. Project preparation, there are several project preparation facilities in operation, but not in scale that is sufficient to support the strong pipeline of projects. And this is going to be a key issue because you really need concessional financing. And I hope that the Green Climate Fund will make this a very early kind of goal in thinking about, and I hope so will any new institution. Now, against this backdrop, what's the potential role for a new development bank? This is the statement from the declaration of the 5th BRICS Summit in March of this year. And it's really encouraging that the BRICS are thinking about such an institution. What I'm saying is not from the perspective of the BRICS, but that from an outside perspective. But we have great hope that this institution can be a game changer. As I said, developing countries face huge financing needs. And in that context, a bank that not just adds to the pool of financing, but that catalyzes changes in the architecture will be very powerful. And if you look at the constraints I mentioned, the official development institutions, and particularly the MDBs, are highly constrained, not only through their capital, but through their policies and procedures. A lot of risk aversion, as I mentioned. They have been very timid with respect to the deployment of lending instruments, limited project preparation facilities, and governance structures that are rooted in the 19th century, not even in the 20th century. So we need to have changes, and a new institution and the debate about a new institution can help change the discourse, and that's what we very much hope will happen. So when you look at the value of such a new institution, it can augment the amount of long-term financing, not only by directly providing, but by leveraging. And this is something, again, that applies to the Green Climate Fund as well. It's a very, very important role for multilateral institutions is reducing and mitigating risks. How do they do that? They do that by really buying in, crowding in investors on the one side, and on the other side, the governments. Because the nature of infrastructure is such that governments will always be present in or just outside the room, because they have so much of a bearing on the viability of an infrastructure project. So by having an honest broker that can intermediate that risk at the outset, and that can provide comfort that as issues arise, they will be resolved, is very important. As I mentioned, a new institution can stretch and augment the frontier of financing instruments, the balance between equity and guarantees, for example. Very, very critical will be to take cost-effective approaches to very legitimate issues of safeguards, social safeguards, environmental safeguards, but to do it cost-effectively. I often say that the European Investment Bank takes 1/10 the amount of time that the World Bank takes, and it lends at 1/10 of the cost of the World Bank. Now, perhaps the European Investment Bank is too light, but there is no doubt that the World Bank is too heavy. So you do need to be able to take cost-effective approaches when you approach the issues of, ensuring that the infrastructure is sound. Very important to spend, to not only provide money, but to provide capacity support, especially for policy and institutional strengthening. When I was in the World Bank, we used to do, what we used to call Power 1, Power 2, Power 3, Power 4 projects in countries. And a very, very important component of that was strengthening the institutions in the country that manage the electricity sector or whatever else. So it's very important actually for these, especially in low-income countries. And finally, as I said, to serve as a catalyst of change. Let me stop here. Thank you for your attention and pass it back. Thank you.
Thank you, Amar. Very, very interesting. And now we have one idea of what could be one of the institutions that could occupy that space in 10 years. Let's hear about another one. Iwan, the floor is yours.
Thank you, Amar, and nice lead-in to my presentation. In fact, many of the issues you raised around gaps and needs around infrastructure fit neatly into some of the things we're doing or focusing on as part of the Green Fund, but also in AusAid itself, the organisation I work for. So thank you for that. And good afternoon, everyone, and it's great to see so many people here for this presentation. And I suppose it's a pleasure to be here in my capacity as the Deputy Director General of AusAid, but also as the Co-Chair of the Green Climate Fund. My presentation today will focus on three areas: the infrastructure financing gap in developing countries and the major bottlenecks that we're experiencing there, and Amar's already covered some of the arguments around that. The role of the Green Climate Fund in the new financing architecture for sustainable infrastructure, and I'd like to also cover some ways to overcome the major bottlenecks that we're experiencing in terms of finance architecture at the moment. So, firstly, the demand for long-term infrastructure, the financing gap. The demand for long-term infrastructure investment is projected to rise substantially, and we've seen that in the presentation just delivered, as emerging developing nations continue to urbanise and industrialise. And the Asian Development Bank estimates that in this region, in the Asia-Pacific region, we'll need an estimate of 700 billion each year until 2020 to meet infrastructure needs. In addition, according to the B20, we will need an estimated $6 trillion investment in green energy infrastructure out till 2035. So they're big numbers in terms of the financing that will be required. And of course, as we've seen already, these needs far exceed the financing capacities of the public sector and the MDBs as they're currently in place. Therefore, we need to look at how private capital will need to play a key role in helping meet that financing gap. So the bottlenecks in financing infrastructure. So the importance of mobilising large-scale private infrastructure investment has long been recognised, but investment flows to date have consistently fallen far short of our expectations. Some countries have been more successful than others in attracting private investors, with some sectors, notably telecommunications, have proven more attractive than others around, for example, water and sanitation. So large institutional investment funds, such as pension and superannuation funds, can potentially play a role in infrastructure financing if key risks can be overcome. And many of you know the amount of finance that's available in those funds. So it's a challenge for us to address some of the risks that are preventing that funding flowing into the areas that are most in need. And some of the key risks associated with the regulatory and legislative frameworks of developing countries, including poor governance and weak institutions, and many of us are aware of that. Limited protection of property and contractual rights, and other laws that affect the operation of private firms, such as those that govern land acquisition and ownership, licensing requirements, tax rules and employment laws. Additional hurdles beyond these include clean energy investments or climate resilient infrastructure are often more expensive and require increased upfront capital, and therefore are not financially attractive as traditionally infrastructure investments are. In addition, investments in renewable energy sources such as wind and solar energy have become commercially viable in developing countries where additional funding sources are available, such as through carbon market financing. So in summary, the challenges therefore around this particular area relate to, first, the challenge of reducing the risk for the private sector. And this is an area that we've been grappling with and hearing a lot about from the private sector in relation to the Green Climate Fund. And a lot of this relates to the regulatory and governance frameworks that are in place in the countries that we'd like to see funding flow to. Second, the challenge of increasing the profitability of the private investment in clean or climate resilient investments is another challenge that needs to be addressed. So work of different multilateral organisations. In responding to these challenges, there's a role for international organisations in supporting developing countries to drive these reforms that attract private sector participation in green infrastructure. And multilateral organisations can play a key role in addressing these infrastructure financing gaps, and we've already heard that so far. Multilateral forums such as the G20 are working to unlock some of the major blockages in infrastructure financing, while a range of institutions are working together to address the barriers to scaling up climate resilient and clean infrastructure investments. So the Green Climate Fund. So the Green Climate Fund is currently under design, and for those of you who are interested, the board's met on 3 occasions, and the 4th board meeting will be here in Korea in 2 weeks' time. It aims to be an ambitious and transformative fund, so something that's quite different from the existing funds, to deliver a high impact in terms of results. So results is one of the key focuses that we as a board are looking at in terms of the fund. It'll also be seen as an opportunity to contribute a significant amount towards the 2020 goal of $100 billion going into climate financing. And it also has a very wide remit around mitigation and adaptation activities. And while not yet decided, as the business model for the Green Climate Fund is being strongly considered over the next 2 meetings, it has the opportunity or the potential to play a key role in this field of infrastructure financing. And that's one area we've discussed. And I also noted earlier AMA commenting on the focus of the fund around both grants and concessional lending, which will be the initial sort of focus of the fund. In addition, the private sector facility is probably one of the key aspects of the fund in terms of its success. So what we're trying to do is unlock a significant source of funding for climate change action by promoting both private sector participation, including local small to medium enterprises. And we have spent considerable time consulting through the private sector, and we have private sector involvement as observers within the board. And also supporting private sector involvement in SIDS and LDCs. So this is another key area of focus. We're also currently in the initial stages of developing this facility, and as I said, we'll be aiming to take some decisions on this in the next 2 weeks. But the ongoing discussions with the private sector have reinforced the comments that we've heard here throughout this summit, but also things that won't be surprising to you. So addressing the barriers for private sector in climate investments, including by having a clear idea of its risk appetite. This is one of the issues that is consistently spoken about by the private sector and within the board. How do you de-risk some of these investments and get that balance right so that you can attract financing into areas that are not traditionally areas that the private sector would invest in? The second thing is, what ways can we incentivise the private sector to engage in relation to the private sector? For example, buying down risk and providing guarantees for investments. Okay, some of the obstacles to financing sustainable infrastructure, and I'd like to just finish by commenting on three aspects that AusAid, the Australian aid program, is focusing on in the Asia Pacific area. And it's about trying to demonstrate the type of projects that are already being funded and working in relation to sustainable infrastructure financing. So the first one will be development of new financing approaches to pool public and private resources and address the financing gap for low carbon infrastructure. The second will be the role for development assistance in building an enabling environment. And the third would be to standardise the consideration of adaptation measures into the infrastructure project design cycle. So case study one. So in East Asia, and we saw from Amar's earlier presentation some of the large needs within East Asia, AusAid's partnering with the World Bank to develop a new public-private partnership approach to financing green infrastructure. The pilots will commence later this year, and what this does is it allows the pooling of funding. What that achieves is it leverages market interest, including particularly from institutions such as the GCF. So there's a potential to actually attract the interest by pooling that funding in greening infrastructure investments. The private sector investor pays for the hard infrastructure assets, and the public finances close the viability gap through pooling domestic sources, okay, international funds and carbon market offsets. So the private sector pays for the hard infrastructure assets, and the public finance closes that viability gap. And this is the framework, very colourful, isn't it? Green on one side and blue on the other. But what it's doing is it's comparing energy infrastructure options in developing countries, and traditional energy sources such as coal, for example, may be currently the only viable option available. But if new financing sources are pooled with private capital, clean energy alternatives become financially viable. So it's incentivising through the use of the funding for change behaviour. It also, through monetising the environmental benefit of renewable alternative and attracting international finance to close the gap. The unique aspect of this framework is that it's embedded in the regulatory framework, okay, so that developing countries' regulatory framework around sustainable development, it's embedded into that process. Okay. Case study 2 is around the Pacific Regional Program. And AusAid's work in the Pacific is helping to demonstrate two things here. One, that donors and new institutions can play a catalytic role in helping to set the right policy framework and build domestic capacity of developing countries to ensure that infrastructure investments, public and private, are climate resilient, and developing partners can shape the environment through investment in climate data, building in-country scientific capacity, building codes and infrastructure risk assessments. and assisting with the prioritisation of infrastructure upgrades. So some of the challenges that a developing country within the Pacific will experience are around some of the enabling environment that they are faced with. So support that we can provide to try and minimise that risk will also help. Enabling lessons for the new finance infrastructure. Public finance, including from donors, can play a catalytic role. I've just been through that and talked a little bit about that. I'll just go on for one more. So case study 3, this is the Samoan Parliament complex, and we talked a little bit about earlier on about countries not or being hit with the challenge of maintaining existing infrastructure. In this particular example, AusAid undertook a climate risk assessment in relation to this project, and with the deployment of a climate change specialist as part of that design team, we were able to identify the need and the risks in relation to the infrastructure of Parliament House in Samoa. The costs and benefits in terms of this particular chamber were assessed, parliamentary chamber were assessed, and each of the risks were identified, including seawalls, raising the platforms, increased drainage, pipes and gutters, embankments. And the reason for this is that many of the development gains that are made within these countries are either reversed very quickly or eradicated through the effects of climate change. So how could we put forward a case to the Samoan government that would be persuasive in terms of the need to undertake work in relation to this, this particular part of infrastructure? And the cost-benefit analysis of this showed that the adaptation costs in relation to the project value was just 4%. But the benefits that flowed in relation to the most effective return on investment was over 200%. So the case was built for why you would want to take work in relation to this infrastructure on in terms of the considerations of the Samoan government. But what it shows, I think, is that in a lot of these cases we need to build in the economic benefits and the economic case for consideration of different project choices that governments would make within developing countries. And we have the opportunity in AusAid to support that capacity development, and we've done that through this project. And as you can see, this project's vulnerability was going to increase significantly over the next 50 years, and therefore we undertook that reform. Just in summary, I really just want to leave you with a couple of points, and they just emphasise the points Amar made earlier. The scale of the infrastructure financing gap is very significant, and the financing gap for greening infrastructure is even more significant. The Green Climate Fund and other new institutions can play a key role, and we heard about the BRICS Bank earlier, in overcoming the infrastructure financing bottlenecks, including through reducing the risk of private investment. And I think this is the major challenge for all of us, is around how we reduce that risk to increase the investment of the private sector in sustainable infrastructure. And that a range of reforms are being implemented that will assist with scaling up public and private investment in sustainable infrastructure. And new institutions should consider ways of supporting these reforms, including through pooling investments, building an enabling environment, and mainstreaming climate resilient considerations into infrastructure design. I think the opportunity that we now have in front of us in terms of the institutions that are being developed to close this gap is a real opportunity, and we should work hard to try and meet and take that opportunity to close the gap. So thank you everybody for your attention.
Thank you very, very much, Ewan. That was very interesting, and two very interesting and very complementary perspectives, in fact, from these two initiatives. Now, one thing that we heard you say, Amar and Ewan as well, is that really in the century, if we want to say the couple of decades in which we hope to eradicate poverty, we run a huge risk. And this risk is that we just lay the wrong foundations for future growth, so that the aim and aspiration and potential to achieve a world free of poverty may become very ephemeral, because climate change may reverse that fairly quickly. I think nowhere this is more true than in Africa. And Mukoshi, could you tell us a little bit, in your view, how this institutions and this institutional framework, what characteristics does it need to have? You've been intimately involved in thinking around the New Development Bank that BRICS countries have pioneered. What are the characteristics that, in your view, will enable this to meet this challenge on financing infrastructure? Yes, in South Africa, more widely in the sub-Saharan African continent. South Africa is a gateway to that, but also more globally. What are the key characteristics, in your view, that these institutions and this architecture should have?
Ama and Ewan for laying what I think is a basis for this discussion, particularly for our region. And you're quite right. There are regional differences in terms of where countries are, both for scale of funding needed, as well as for the environment for financing these projects. But just focusing on the African continent, I think from the two presentations, I can say that most of the issues that have been addressed really fit very well into our environment. And in my view, what is lacking from the current architecture, particularly with regard to the sub-Saharan African continent, in addition to what has been explained, is the ability to finance regional projects. As you know, sub-Saharan Africa, or the African continent, has got a lot of landlocked countries. And some of them, either because of the recent financial crisis or basically because of the size of the countries, it doesn't really make sense to undertake some of these projects on their own. So there's a need to look at different ways of bringing together 2 or 3 countries in a more innovative way of supporting these infrastructure projects. And in our region, in sub-Saharan, in Southern Africa, we have managed to kind of pilot some of those projects. And what do those projects need? One, they need definitely a pooling of resources. Second, they need some kind of guarantee that whatever is it that the project is being built upon, if it's an infrastructure project, that there will be an off-taker of what is being produced, because in the as I said, most of these countries are small. So, for example, one of the projects that was and is still continuing to be developed is the Lesotho Highlands Water Scheme, which, if you look at the country itself, a country of 2 million people versus a neighbor like South Africa with almost 50 million people, has been able to produce and will continue to produce enough water, one, to supply not only Lesotho but South Africa and other neighboring countries, as well as to allow Lesotho to develop hydropower out of it. And so for me, the ability to undertake regional projects is one element that the new architecture will need to bring in. Secondly, the ability to pool project, but more importantly, the ability to bring in innovative financing instruments like guarantees to make sure that the project itself, the risks and the costs are mitigated.
Thank you. Just one more thing, Mukoshi. One of the things that also came out mostly from Amar's presentation was the issue of affordability. and in particular on the fact that it would be not only unfair, but frankly impossible to do this in a one-generational sort of time span. And this points to two things, in my view. One, to instruments that manage to finance this intergenerationally, so borrowing mostly from governments, but also through the private sector. But the other thing that they do point out is, on the affordability side, that concessionality will still be required in many of this infrastructural project to make it work. And I'm thinking about water, but also to a certain extent power, where meeting the challenge of energy access means that in some countries it will not be possible to charge market rates for power in the short term, and that's why concessionality is there. So do you have a sense that this concessionality element will need to be part of the blend of instruments that needs to be made available?
Absolutely. In fact, that's one of the things that we are hoping that the existing institutions, in partnership with the emerging institutions, will continue to provide. I don't know why up to now the World Bank has not been able to use its concessionality window to support infrastructure projects in low-income and developing countries. But certainly there's a way that you can use concessionality to try and bring down the costs and to leverage other funding that comes from the private sector. And more importantly, to be able to finance the project preparation that is required. So in most cases, when we engage with the private sector in our region, the one thing that they always complain about is it's not money, but it's the availability of bankable projects. And where do you need a concessional funding to come? You need it to come in at the early phases where you're able to prepare this project. You reduce the risks for private sector, and in that way you are able to see private sector coming into financing these projects. And secondly, I think concessionality can also be useful in the example that was shared with us on the South Asia Pacific. It's very much to also provide capacity building. I think most countries, and certainly speaking about my region, is that the capacity to deal with the policy environment, the legislative framework for some of these projects is just not there. So you're not even talking about the projects themselves. It's about ensuring that they are, you establish policies that will be able to ensure that the maintenance that Amma was referring to happens, but also that competition in the sector happens. But more importantly, ensuring that the safeguards that are so important as well to these projects continue. And those are things that we cannot expect the private sector to pay for.
That's I couldn't agree more. And this is a problem developed countries have as well. When they start off a project, someone needs to put the money up front, and most of the project preparation in Europe, for example, tends to be financed through the budgets of large companies that take on that on their books, and they have the ability and the financial space to wait and ensure that the project delivers later on. And this is not something that it's possible yet in private sector in poorer countries. And also the way, as you point out, it's not only the project preparation itself, the whole sort of framework around it, which is about capacity building and having the right policy in place. It's a good conduit to you, Brindusa. So you have a very, very privileged position from WEF to look at how private sector companies are looking at the space and the appetite they have to work in this space. So could you tell us, in your view and from the interactions you have with the corporates that you interact with at WEF, what are the key characteristics that they'll need to see in this infrastructure in order to be able to come in and really play a leverage role on the back of the public funding that will be available?
Thank you, Mattia. And And you mentioned the World Economic Forum has a privileged position. I think we used that position a year ago to set up a process that you mentioned at the beginning. It's called the Green Growth Action Alliance. We launched it at the G20 last year with support of the Mexican presidency. And since then it has grown to encompass around 60 members. There are public and private financing institutions, and there are also project developers, but also governments, donor governments, and also from the multilateral development space and the International Development Finance Club. Together, the goal of the alliance was to say, how do we actually scale up private financing for green growth? And we focused not necessarily just on infrastructure, we focused on specific sectors. Renewable energy, energy efficiency, and climate-smart agriculture have been the sectors that we focused so far. And as I said, in the past year, and you will see a progress report being released tomorrow on our website, in this past year, some of the things that we've managed to do are quite concrete. We set out to actually go and test and incubate these solutions in countries, not just actually design theoretically the concept of it, but how could we actually do it? And so we did some work in India to set up a facility that would support the price of renewable energy certificates, so that to see how could the market then support the financing of solar projects in the context of the solar mission. We did some work in Kenya to understand how an insurance for geothermal well output could actually help investors come in earlier and help the government get out earlier from the scheme. We're doing currently some work to set up an energy efficiency fund in Mexico for buildings to try to understand how would that work, a layered risk-return energy efficiency fund in which public finance would work with private investors to do that. And finally, we're putting together a $50 million fund for agroforestry projects in Vietnam with involvement from the government of Vietnam, trying to understand how to design such a fund in a context for smallholder farmers. So really very concrete problems, and try to look at what are we learning from those. So really, I'm just for the purpose of understanding how public finance and public finance institutions could actually be helpful, I actually selected 3 of the learnings that we've had so far. I think one of the first things that became obvious to us was that we would need a greater donor coordination in country in order for that money to flow effectively. I think multiple donors, and especially in countries that are, where there is a good degree of good governance, where donors donors love to actually operate in those countries. We need to have a better coordination, because they become very difficult to navigate for private finance. Who do you actually talk to? And one of the good examples that we've seen, for example, in Kenya, there are over 20 donors present in Kenya, and all more or less related to clean energy to some extent or the other. They actually have a coordination platform with only 2 governments that are co-chairing that. It has been very, very helpful to have that one point of access for private financing. I think we've also seen that neutral platform that we have brought in the country for discussions is helping, if you like, public finance understand at which point they're actually crowding out private finance, at which point that concessionality actually instead means competition with the higher interest rates that commercial banks provide. And otherwise, there's a fine line balance. You actually do need the concessional finance, but you need at some point to understand when to sort of move out. Or clubbing, as we've seen in some other places. I think the second, I would call it barrier, but also an opportunity at this point, is that with the limited budgets available, it would be interested in markets that are investment ready to shift the focus from public financing, from grants, particularly into de-risking and catalyzing private investment. So this is, we've all said it today, but in practice that actually means there's a series of programs on the ground that still do provide grants and concessional finance and do not actually have access or understanding or capability to support those de-risking mechanisms. And so we believe, and the Alliance Act members believe, that, for example, introducing a reporting on private sector leveraging for public financing institutions at the G20 would be a start. Every G20 would actually induce that kind of change that we would like to see. The third element that we sort of noticed is that public finance could actually help to increase the absorptive capacity of host countries. And what we mean by that is of the multitude of funds that are being made available, I think very small percentages are actually being absorbed by projects on the ground and by private financing. And if we are talking about leveraging, we have to also think about how do we actually build capacity at the government level, but also at the private sector level. Many of the domestic banks actually have no knowledge in financing for the green growth sectors. They have no knowledge in dealing themselves with the risks that such projects may bring. And I think just demonstrating the ways and means to achieve, to accelerate investment is also a role for the public financing. I'll just leave it at that for now.
Oh, that's really great. Thanks, Rundusa. I like some practical suggestions, and your 3 points I think are all very good, and you even suggested to bring some of this report into the G20. I think all of you 3 gentlemen will go to G20 meetings, and Australia will host the G20 soon, so I'm sure they will bring those messages back to those audiences. Now, I'll go to the audience in a few minutes for question and comments, whomever wants to join in the conversation. But before that, Emanuele, you come also from the private sector, a carbon disclosure project. It'd be good if you could tell the audience a little bit about it to start with. But the angle really there is institutional investors. And what are the investors that sit on their pension funds and are a bit unaware of how their pensions are being used? How can they do something so that in 10 years' time, the infrastructure, sustainable infrastructure landscape, the financing for it looks different?
Sure. Thank you very much, Mattia. And good afternoon, everybody. Yes, CDP, the former Carbon Disclosure Project, we recently rebranded, is a UK NGO that was formed 10 years ago to increase transparency around climate change initially and carbon emission. This initiative was endorsed by institutional investors, and throughout these 10 years then CDP has grown with over 700 institutional investors supporting the initiative and asking and requesting disclosure to listed and unlisted companies around climate change, water and forest risk commodities. And the rationale of change is that what gets measured gets managed as well. And the growth, the massive growth of this organization has been done thanks to the support of institutional investors, mainly asset owners, asset managers, but also banks, which they needed clear, standardized information in order to make investment decisions or in order to engage with companies around their environmental externalities. And we've heard yesterday a lot about the unburnable carbon report, which it did definitely shed light about a critical issue for institutional investors. And I need to say that I agree with what Michael Liebrecht said from Bloomberg New Energy Finance, that the concept of stranded assets among institutional investors now is very much similar to the subprime financial crime that just a few years ago we had, where there were clear signals of the failure of the market, but institutional investors didn't do enough until the actual bubble itself exploded, and then they had to pay the consequences of it. So what is the main reason why institutional investors are mainstream institutional investors, I would say, because then of course they are like SRI, social responsible investor, faith investor, mission investors, which they are much more advanced and progressive in addressing those issues in their investment belief. But what is the main reason why institutional investors are not factoring climate change in their investment decision-making process? The main reason is that emissions are still an externalities for the company, and it's very difficult for portfolio manager to factor externality if they are not able to factor them in their fundamental analysis, if they cannot factor them in their discounted cash flow forecast. I mean, there are studies and there are investors which they're actually creating some scenario analysis where they say, or some stress testing analysis where they would say how their portfolio would perform if the price of carbon would be of 100 or 150. And of course, the valuation of oil and gas companies, it would fall massively. But and there's been a recent HSBC report just following the unburnable carbon report, which said that the valuation of oil and gas company would actually fall something in between 40% and 60%. So why institutional investors are not taking action on it? The reality is that there's still scenario analysis. It's all, you know, when and if a strong carbon price will be there in order to factor in the fundamental analysis of the corporation. The reality is that the majority of the analysts are clearly telling investors that there is not a clear, they're not sending a clear message that there will be a strong regulation about emission yet. So it's not profitable to consider and factor climate change or other externality in their investment decision process. Another reason why they're not doing so is that the majority of investors, and this is another problem linked to the reason of one of the barriers to unlock and untap infrastructure investments is the fact that because of cost saving and the financial crisis, lots of investors as well, they're following passive investment strategies where they're not taking actual active decision on which stocks or which investment to do, but they're tracking, you know, benchmark and indices of the market. So it's very difficult for them to underweight or completely exclude a specific sector. So therefore, in the lack of this strong governance and regulatory regimes around climate change, many institutional investors, especially the more progressive and the more forward-looking investors, in order to buy some time around climate change, they're leveraging their authority and their influence of their active ownership over this company and trying to influence the corporate behavior in order to drive a positive change. And for example, at CDP, as I said, we started 10 years ago as an organization that was there to increase transparency and disclosure and increase accountability of this company. But for example, 3 years ago, a smaller number of institutional investors specifically request to us that, you know, disclosure was not enough. There was a need for action. A company needed to make carbon mitigation at the core of their strategies. So 3 years ago, together with these institutional investors, we created this initiative that we call Carbon Action. And Carbon Action, the aim of Carbon Action is to accelerate company action on energy efficiency, and carbon reduction activity, which they've got a positive return on the investment. And it is now supported by 200 investors globally, both in emerging and emerged markets, and with 18 trillion in assets. And so far, in these 3 years, Carbon Action, the key results of Carbon Action is that of the 200 companies that receive a request from institutional investors, and these companies, they were mainly in energy intensive, infrastructure intensive sector, to set up a target, other absolute of intensity target, 61 companies that did so. They did disclose an official target to their investors. And in total, companies reported 500 million tons of CO2 as a result of emission reduction activity and not offsetting, and this equals to $11 billion of US dollars. And we have analyzed all this emission reduction activity, which some of them are really, again, very much linked to the infrastructure investments. And what we saw is that these activities, they actually producing to this company 33% of return on investment with an average payback period of 3 years. But our analysis of the Carbon Action Initiative also shown that targets are not strong enough, and what corporates are doing to reducing emission is not strong enough. Their emission reduction activity, they're not strong enough, especially to match what the IPCC target of 1.7% annual reduction in CO2 by 2020. So I do believe that investor engagement, it's an extremely useful and important discipline. It does reduce risk and increase the return on the portfolio. And institutional investors, they do see the value of doing so and encouraging company in addressing carbon mitigation strategy. But of course, climate change, as I said, it is an externality. And in order to internalize the climate change, there is a clear need of a strong regulation to do so. And therefore, what institutional investors should do over the following year is to being able to influence more strongly the formation of a strong, solid, robust international carbon price. And of course, another important point that institutional investors should do is to engage with companies which they're obstructing climate change via their lobbying activity, either direct or indirect, which is another critical point. And the third point, of course, is to collaborate with this current and new institution, such as the institution that we'll be talking today, the BRICS New Development Bank and the Green Climate Funds. But in order to do so, in order to partnering with this institution, investors, they do need some clear and strong structure and governance from this institution. So I believe that, you know, they need to, like you were mentioning before, investors, they do need some clear signal of attractive risk and return profile of these projects. They do need some very strong, robust, but flexible governance of these institutions as well. They need to be able to input on the governance, and the governance needs to be flexible in order to adapt to the reality of the market, of the financial markets, which we know, you know, they're very much short-term oriented. And investors, in order to have confidence on this institution, they need to see a strong government support of this institution, both in terms of capital, but also in terms of policy and regulation in the local markets, to being able to find a favorable marketplace where to invest in green infrastructure. And last but not least, I think, you know, what is important for institutional investors as well is to being able to see within this institution a strong and robust long-term vision around climate change. And this would really build the confidence that investors need in order to partner, to finance, to co-finance, or to promote the financial products that this institution will create.
Thank you very, very much, Emanuele. I must say, I don't know how you guys feel, but it's a real challenge. Before the portfolio managers of these institutional investors who are used to working within their restricted parameters start not only integrating some of the issues that you mentioned, thanks to regulations, but as well as thanks to their ability to see the long-term risks and opportunities that choosing different companies have, it's going to take a while, and I can see that as a challenge. But at the same time, what we were saying earlier, Mar, the intergenerational element. This is crucial. We're not going to be able to do this until we find a good way of resolving this intergenerational problem. And to me, if we don't involve the institutional investors at scale, that problem is unsolvable. So it's a huge gap, but I gave us 10 years, so I think 10 years it should be. Now, shall we open it to the audience? Is there any questions or anybody that wants to come in from the audience? I have 3 hands. Great. Ron, do you want to go? Oh, sorry. Microphones. Okay, move in front, Ron, please. Yeah, thank you. And the other gentleman, if you can prepare and go near the microphone so that you can ask your question.
Hi, Ron Benioff with the Global Green Growth Institute. It's an excellent session, and I commend Mattia and all the speakers for holding the session and for your remarks, because I think we don't pay enough attention to the need to look at how we're going to shift infrastructure investments to achieve the transformational change needed in green growth. My question is about individual governments and examples that you have of governments at the national or state or local level, say the Chicago recent infrastructure investment fund, that are really providing some innovative approaches at de-risking their own markets to mobilize investment and really setting the agenda to move infrastructure investments in a line that line up with their green growth goals. So interested in any examples you can provide, and also whether you think it would be helpful for further work to be done to documenting and sharing experiences that some of the leading governments are taking. To me, that seems like something that could be extremely useful so that we can all learn from some of the innovators out there with the governments. Thanks.
Thanks, Ron. Yes, please. The next person. If the person that had their hand up can come up to the microphone as well. Thank you. We'll take 3 questions and then go back to the panelists.
Hi, thank you, everybody. I'm Bamsuri, coming from ISGAN, the International Smart Grid Action Network Secretary. Thank you for your good, valuable discussion today. We are talking about very tangible issues today. So my question is, everybody agrees that today all presentation speakers tell us that the needs for the funding is very increasing very sharply. So private sector's funding and investment also need is as well as the private sectors. So everybody knows that the private sector funding and investment must need to be some certain level of probability level. Otherwise, they cannot invest money. So in these cases, I'd like to give some my question, Mr. McDonald. So do we have any mechanism how we guarantee some return for these private sectors? And in these cases, how this GCF or some new such kind of financial institutes having some methodology and some ideas to keep some level of probabilities. Thank you.
Great, thank you. Thank you very much. One more question.
Thank you. Hi, my name is Sarah. I'm working at the UNESCOP at the Incheon office currently, and my question would be, well, I do welcome the current trend of increasing interest of private sector investing in the public infrastructure, especially related to green growth. But my concern is investment, in the end, the goal is to achieve profit. And that means it'll increase efficiency and funding, but will it also lead to equal access to people, especially in the vulnerable population in the regions that tend to be most greatly affected by the climate change? And the reason I ask this is because there has been the structural adjustment programs in the past. The whole argument for it was that private sector investment will lead to greater efficiency and it'll lead to economic growth. But yes, that was true, but it also limited access. So how can we ensure that this time private investment won't limit access to the vulnerable population? Thank you.
Great, thanks, Sarah. An easy question to answer that one. Good. We'll ask Amar to answer that one. I think he's been thinking about it. Okay, so audience, panelists, who wants to take on the experience from the leading countries? Ron asked that question. Ron runs, by the way, our GGBP, the best practice, which collects this information and stuff. Amar, do you want to give it a go?
You want to go and then I'll follow up.
Okay.
Okay, thanks. Well, thanks, Ron, for your question. I mean, I think this is one of the challenges we've had in the Green Climate Fund. So in the interactions we've had with the private sector, it's gathering those best practice examples and being able to see whether we can put those in place in a scalable way, if you like. So there's a number of best practice approaches that are that have been undertaken for, small or medium type enterprises that we've seen with private sector investment. But how do we, are they going to be scalable as we go forward? So what we've tried to do is not try and second guess that, but to get the private sector to talk to us about how those things could be put in place as we go forward. So as we design, just building on that, as we design, for example, the private sector facility in the Green Climate Fund, well, what is it about that would attract the private sector to engage with the fund? So, for example, do you have private sector involvement in that part of the facility or not? So some of the decisions that need to be made around that part of the fund relies on the best practice or the examples that we've had. Now, we do have quite a number of examples. I gave some earlier in the presentation. So we're gathering that material, we've gathered that material up, and is feeding into the papers and decisions that the board is making. But I think, it's a challenge we all have around knowledge gathering, if you like, across the board, and it's not as available as you would like. And just finally on the private sector, the other thing I'd say, and the comment was made by somebody in one of those questions, I think there is greater interest from the private sector in the green, the sustainable infrastructure, if you like. It's been a shift, and I mentioned this earlier to Amar and others I was talking to. You can see the interest, but the interest relies on us working in partnership to address some of those issues that have arisen and people have raised through this presentation here. And they're not easy to balance the de-risking of these things with public funding and the comment that was made in the last question about the vulnerable populations and the like. Yeah.
Thanks, Amar. And then Makoshi.
On the role of individual governments, I think what you said is actually very intriguing, which is that you have to think about different levels of government, right? I mean, in the US, for example, at the national level, there is gridlock, but there's so much happening at the local and the subnational level. Ideally, you need reinforcing mechanisms. My personal view is one area of huge action is going to be cities and city governance. So when you look, and I was mentioning to Alex Bowen, when you look at emission levels in New York, it's half of the national average. When you look at emissions levels in Beijing, it's twice that of the national level. So when you think about the potential, there's huge. And in a way, we are sitting in one of those experimental cities, which allows you to actually get the kind of knowledge that is mentioning. But I do believe you need strong national leadership and vision, because there's so many issues that are cross-cutting. And it was really inspiring listening to the minister from Costa Rica, because that was really a kind of a national vision. You wouldn't achieve that without a national vision. But I also think that you can learn a huge amount at subnational levels and city level that can be food for experimentation. On the role of the private sector, I do believe that there are very important efficiency and institutional gains, as was mentioned, that comes with private sector engagement. And indeed some, let's say, governance gains, because there are disciplining elements, etc. But at the same time, they can't be taken for granted. It really depends on the nature of interface, etc. There's another aspect which is a little bit more complicated, which is the provision of finance and the expectation of returns, as was mentioned. I often say you cannot have the expectation of double-digit rates of return on the back of the poor. It just doesn't work. Okay, so you can't produce electricity and say, well, I produced the electricity, and then you produce it at a cost that the poor cannot pay for. So in a way, affordability does matter. So you have to separate these two elements. So in a way, what's the answer? It's actually bringing down the risk so that private sector would be happy with a reasonable rate of return over a long period of time. So risk mitigation, again, coming back, is a very important part of the equation. So I do think that it's going to be very much case by case, and the idea of concessionality is to meet that test that yes, it's improving affordability, but it's not crowding out the private sector.
Yeah, I agree fully with you, Amma, but I think most importantly, we cannot avoid the role of government in ensuring that energy policies that they put in place are inclusive, and that they don't leave out those that are vulnerable and they cannot afford. And that is really the role that policy has to play. In ensuring that those projects do not happen in isolation of the communities where these projects are undertaken, that the communities themselves get to benefit and they become the agents of change in their own way. One, in using the energy, but also making sure that they use it for productive use as well. And that, I think, in itself will also address the gaps that you find in our countries. But just coming back quickly to the issue of examples, I think I will talk about my own country and our region, because we have some of the examples of how to do this in an environment where government itself sets policy, so it introduces a level of predictability for investors who want to come in on a long-term basis. And in South Africa, with the Renewable Energy Investment Program, where government said clearly, this is where we are in terms of our energy mix, and we want to increase to this level by such and such a time. So in a way that investors, when they come in, they know that they are there for the long haul, and they are there to add on to the energy mix that government, that the country has. So they are not alternating one energy for another. It's actually more about adding, because as you know, or you may not, South Africa has gone through challenges of having blackouts. So it's about adding onto the energy grid, but doing that in a more, using more in renewable energy. And just also ensuring that the government provides that concessionality that we're talking about, to ensure that the private sector that comes in is able to take up these projects at a much more reasonable, looking at a much more reasonable rate of return. Just two examples. One is we were recipients of the Clean Technology Fund. So if you look at the mechanism that pulls in donor funding, and it goes directly towards financing some of these renewable energy projects. And out of that, I thought about 6 months ago, but now Google has come in and they've overtaken government. We were thinking that we were going to be the first to come up with a 100 megawatt solar plant, as well as a 100 megawatt wind farm. Now, what has happened, just with the government putting out a tender for RIPPs, you have companies that have now come in and they are bidding for this and able to double up what government itself had set itself to do. So in a way, there is scope for policy certainty, also for predictability in terms of what you are aiming for in the future, that makes investors comfortable that they are in it for the long haul.
Thanks, Mukoshi. I must say this was a very interesting point. And one thing that the 2 points that you made and Amar's point made me really realize is that we really need to think about this very carefully, not to make some of the mistakes that had been made in the past in terms of inclusiveness. I think Sarah mentioned in her question the unmentionable, the Voldemar of development, structural adjustment, and it's extremely important that we learn from the lessons of the mistakes that were made implementing those policies, not to make them again. And I think it's reasonable that countries have fears about that. So that will be a crucial part. Well, thank you very, very much, all of you. I think we spanned across a very wide range of topics, from what should we do to have institutional investors, project managers put the percentage of their funds towards the GCF or towards a new, or co-investing in a new development bank, to moving away from grants to what Rindusa, you rightly called de-risking and catalyzing, to really thinking about the inclusiveness to meet this incredible challenge. Good agenda of work for us, I think, at the GGGI. We're working on these topics, integral part of the G2A2. The GGI is also with the G24 leading a research program on pretty much all of these topics. We're coming up with papers on these topics to support, among other things, the New Development Bank thinking. So I believe we'll have some interesting material coming out of this process. Thank you very, very much for coming to this session, and thank you to our panelists.